Hey everyone, and welcome back to TalkTickers.
Good to be here.
Today we're diving into Rexford Industrial's second quarter 2025 earnings call.
Yep, digging into the numbers and what management had to say. Our
mission, like always, is to cut through the noise, pull out the really critical insights for you.
And give you that balanced snapshot of how Rexford's doing and, what the outlook is.
Exactly. So if you want the quick, insightful download on Rexford, well, you're in the right place.
Let's jump right in. Maybe start with the headline results.
Right, let's hit the numbers first.
Okay, so for Q2 2025, Rexford Industrial reported core FFO of $0.59 per share.
59 cents. And FFO, funds from operations, that's the key metric for REITs, right? Gives you that cleaner picture of cash flow.
Exactly. It strips out things like depreciation. And what's interesting here is this $1.59 is actually up a cent from the prior quarter.
Okay.
But you have to exclude some one-time termination revenue to see that comparison clearly.
Right. Apples to apples. And looking forward, full year. Yeah, they reaffirmed their full year 2025 core FFO outlook. So they're sticking with the guidance of $2.37 to $2.41 per share.
Holding steady. That reaffirmation, especially now, feels like a pretty strong signal for management.
It does suggest confidence, yeah. Despite, everything going on in the broader market.
And operationally, what were the highlights there?
Well, pretty positive, actually. Same property occupancy hit 96.1%.
96.1, that's up, 40 basis points from Q1?
That's right. Sequentially up. And they saw positive net absorption, too, about 220,000 square feet.
So leasing more than what became vacant, that shows real demand.
It does. And another thing, bad debt levels were incredibly low, only 6 basis points of revenue.
Wow. So tenants are paying their bills? Strong tenant health, basically.
Seems like it, which leads nicely into the leasing performance.
Yeah, let's get into that. How much activity did they see?
Quite a bit. They executed 1.7 million square feet of leases in Q2.
1.7 million.
Okay. And that included lease-up on 4 of their repositioning and redevelopment projects. So getting those RR projects filled.
And the rents on those new deals, the spreads.
Net effective spreads were 21%. Cash spreads were 8%. Both pretty much in line with what they expected.
Okay, so meeting expectations there. What about the existing leases? Any built-in growth?
Yep. The embedded rent steps in the leases they signed averaged 3.7%.
3.7%. That's up a bit from last quarter, right? 10 basis points.
That is, yeah. So a little more baked-in growth on the new deals.
And activity on the vacant space. Are tenants kicking the tires?
Definitely. They mentioned having leasing activity on about 80% of their vacant spaces right now.
80%. That's way up from 60% a year ago.
Significant jump. Shows much more engagement, more interest.
And are tenants locking in for longer or changing their behavior?
Lease terms seem pretty steady, still in that 4 to 5 year range generally.
Okay.
But what is noticeable is an acceleration in early renewals.
Early renewals. How early?
We're talking 6 months or more before expiration. Year to date, they've renewed 1.1 million square feet that early.
Wow, 1.1 million square feet.
Right.
That's nearly double the 600,000 they did in the back half of last year.
Exactly. So tenants seem pretty keen to lock in their space. Shows commitment.
Okay, so lots of positives on the tenant side, strong commitment. But what about the broader market? Any headwinds?
Oh yeah, definitely some headwinds. Despite that tenant health, you've got the macro uncertainty. Tariffs.
Right, the usual suspects.
And that is impacting some decision making. It's putting pressure on, overall demand, rent levels too.
And lease-up times, taking longer.
And lease-up times, yeah. You saw it in the numbers this quarter.
How much of a dip in market rents?
Sequentially, market rents across their portfolio were down about 3.5%.
3.5%, just from Q1.
Yeah. And year over year, it's down about 12.8%.
12.8%. Oof, that's significant. Any particular reason cited?
Management pointed partly to those big tariff announcements early in the quarter, adding uncertainty.
Okay. So the strategy now is?
Focus on capturing demand, getting occupancy, which, sometimes means you have to be a bit more flexible on rent.
It makes sense. Fill the space first. And looking ahead, occupancy expectations.
They are guiding for a slight deceleration in same property occupancy for the second half.
Oh. Down from that 96.1%?
Yeah, guidance is 95.5% to 96%, mainly due to some specific planned tenant move-outs.
Okay, known departures. Anything else driving that slight dip in expectations?
Well, it ties into the bad debt reserve, too. They're keeping that reserve higher for the second half of 2025.
How much higher?
About 70 basis points of revenue. That translates to roughly $4 million set aside.
Compared to?
Compared to only about $1 million in the second half of last year.
Right. So that higher reserve plus the move-outs, that explains the expected deceleration in same-property NOI.
Exactly. That net operating income growth might slow a bit in the back half.
Okay, so a nuanced market picture. Balancing act. But let's pivot to, well, frankly, where Rexford often looks really compelling, the built-in growth.
Yeah, the embedded growth story.
Yeah.
It's substantial.
They put a number on it, right? Incremental cash NOI.
They did. $195 million in incremental cash NOI potential.
$195 million, that's 4. What percentage growth is that?
That represents 28% growth on their current base. It's huge.
28% baked in. Wow. Where does that mostly come from?
It's pretty clear. 3 main drivers. First, contractual rent steps and existing leases. That's $105 million right there.
Okay, over half of it just from rent bumps already agreed upon.
Yep. Then you have the repositioning and redevelopment projects, the RR stuff. Those in process or in lease-up add another $70 million.
$70 million from value-add projects.
Okay.
And the rest?
The rest, about $20 million, comes from the cash mark-to-market potential, bringing existing leases up to market rates, which they estimate is about a 3% uplift overall.
And they're actually delivering on these RR projects.
Seems so. Year to date, they've leased over 900,000 square feet in those projects,
Generating real income.
generating over $16 million in annualized NOI from those leases. And 7 RR projects have now stabilized.
Stabilized, meaning fully leased and operational.
Pretty much. And the yields are impressive. They achieved a 7.4% unlevered stabilized yield on the total investment.
7.4% is solid, but you mentioned incremental returns.
Yeah, this is where it gets really interesting. The incremental return on just the new capital put into those stabilized projects, it's 19%.
19%. So for every extra dollar they invested to fix up or redevelop, they're getting 19 cents back annually.
That's the idea. Very high return use of capital.
Now, I heard they adjusted RR yield expectations slightly.
They did, down by 50 basis points at the midpoint. But that was mostly due to the mix of projects stabilizing. The priority is still clearly on these RR opportunities.
And the lease-up timing on these projects, still on track.
Pushed out slightly by about a month on average given the current market.
Okay, 1 month delay. What's the FFO impact of that?
Management said even in an extreme scenario, it'd only be about a 1 penny unfavorable impact to the full year guide. So pretty minimal.
Manageable. Any specific RR projects stand out?
They highlighted the Hertz asset near LAX, called it irreplaceable.
Hertz near LAX. When does that lease expire?
March 2026. And it's significant because it brings about $9 million of NOI offline next year.
$9 million offline. Ouch. But they have plans.
Big plans. They intend to develop a 400,000 square foot state-of-the-art industrial building there. They think it'll be totally unique for the market.
Ah, so replacing the old car rental income with potentially much higher income from a brand new purpose-built facility.
That's the bet. Trading up basically in a prime location.
Makes sense. And underpinning all this is their balance sheet, right? How does that look?
Very strong. They have over $1.8 billion of liquidity.
$1.8 billion,
Yeah.
including cash.
Including $560 million in cash. So lots of dry powder.
Which is valuable right now.
Definitely. Gives them flexibility. And leverage is low net debt. The EBITDA is only 4 times.
4 times. That's quite conservative for a REIT.
It is. Plus, they recently recast their credit facility, extended the duration, increased the capacity, and even reduced the interest expense.
So strong financial footing. And how are they allocating capital? Besides RR.
Well, RR is the priority. Then it's accretive acquisitions, but only if they meet really strict underwriting. You're being disciplined.
Makes sense in this environment. Are they selling anything?
Yes, they've been active on dispositions. $134 million sold year to date, another $54 million under contract.
And what kind of returns are they getting on those sales? Cap rates?
Weighted average cap rate was in the low 4% range.
Low 4s. That's pretty good pricing.
It is. And they achieved an unlevered IRR of 11.9% on those deals.
Almost 12% IRR. Nice. Any color on who's buying?
Yeah, an interesting point was that user purchases have been key to getting those premium prices.
Users meaning companies buying for their own operation.
Exactly. Like one Orange County property they sold to be converted for battery storage. That went for about a 3.5% cap rate.
3.5%. When market cap rates for leased buildings are?
Generally 5% plus, according to management. So that shows the premium for specific user demand.
Right. It's not just generic investor demand setting the price. Okay. Zooming out a bit. Overall portfolio performance.
Still demonstrating relative strength, even with the market stuff we talked about.
And that really comes down to their strategy.
Yeah, that focus on irreplaceable infill Southern California spots. The supply constraints there just aren't going away.
Massive consumption zone, limited new space. It's a long-term thesis.
It is. And even within SoCal, performance varies. It's not uniform.
How so? Where's the strength and weakness?
Smaller spaces, like under 50,000 square feet, seem pretty stable. Good demand, rents holding up better.
Okay, the smaller users are active.
But there are pockets of weakness. Mid-counties have more supply in the larger, say, 100,000 to 200,000 square foot range.
Elevated supply there. Any other areas?
Potentially some pressure in central LA and maybe North Orange County too.
So sub-market nuances are really important.
Very. But despite all that, management did say they saw an uptick in overall activity towards the end of the quarter.
Oh, interesting. A late quarter pickup.
Yeah, which kind of reinforces their strategy. Own the best quality stuff in the best infill markets, and you'll capture the demand that is out there.
Outcompete, basically.
Exactly.
Okay, so considering all that the solid results, the market pressures, the embedded growth, the sub-market variations, what does this mean for investors, potentially?
Right. How do you maybe think about this? Which brings us perfectly to...
We're not financial advice segment. Just a reminder, this is purely for informational discussion, maybe sparking some ideas. It is definitely not investment advice.
Absolutely. Always do your own research. But we cooked up a couple of angles based on the call.
Okay, let's hear idea number one.
Idea one, the Hertz redevelopment bet.
Focusing on that LAX project.
Right. So the FFO guidance for 2025 is firm. But we know that Hertz lease expires March 2026, taking $9 million NOI offline temporarily.
Which the market might react negatively to. Short-term thinking.
Could happen. So the idea is consider looking for an entry point, a long position in Rexford, that's REXR, if the stock dips in early 2026 due to that perceived headwind.
Betting that the market overreacts to the temporary NOI loss.
Exactly. The play anticipates that the massive value creation from that 400,000 square feet one-of-one redevelopment near LAX will eventually far outweigh the temporary blip.
Leading to a long-term re-rating? Okay, plausible. What's idea two?
Idea two, the embedded growth alpha.
Alpha from embedded growth. Explain.
Okay, the market often gets really fixated on those sequential market rent declines we talked about.
Right, the manic of 3.5% sequential, negative 12.8% year over year. Headlines grab onto that.
They do. But management was explicit. Rexford's growth is not dependent on mark-to-market gains right now.
Because of the other driver.
Exactly. Because of that huge embedded growth pipeline, the $105 million from contractual rent steps, the $70 million from RR projects already underway.
So the idea is
look to establish a long position in RXR, recognizing that this predictable structural cash flow stream might be undervalued by a market obsessed with short-term rent trends.
So you're betting on the predictability of that embedded growth versus the noise of fluctuating market rents.
Precisely. A play on structural growth over transient volatility.
Interesting angles. Okay, let's wrap this up then. Final thoughts.
Yeah, to sum it up, Rexford put up solid Q2 results. It really shows the resilience of that specific infill strategy they have.
And the value creation engine, the RR projects, seems to be firing?
Definitely. They look well positioned, lots of embedded growth still to capture, strong balance sheet, keeps them flexible.
Agreed. And one last crucial reminder for everyone listening.
Everything we talked about, especially those trade ideas.
Just for informational purposes, it is absolutely not financial advice.
Please always do your own research, your own due diligence.
Couldn't agree more. But we would love to hear what you think about Rexford's quarter.
Yeah, did anything jump out at you? Any questions this deep dive sparked?
Let us know. What angle might you dig into further after hearing this? Join the conversation.